If you walk into a glass tower in Manhattan close to midnight, there is a strange scene that most people have never seen. A brightly lit room, dozens of Bloomberg screens flashing, numbers moving constantly. On the screen, it might be $847 million, the value of a deal being modeled, but the person sitting in front of that screen does not own a single dollar of that money. That is where the journey of most people who enter the world of global finance begins. At the age of 22 or 23, they enter the industry with a title that sounds very impressive: investment banking analyst. But the reality of the job is not like what Hollywood movies usually show. They do not sit in conference rooms with CEOs. They do not sign billion-dollar deals. And they are not the ones deciding the fate of companies. The real work is simpler, but much more brutal. They build financial models, DCF, comparable companies, leveraged buyout models, hundreds of Excel tabs connected together like the nervous system of a giant machine. A small mistake in one formula cell can change the valuation of an entire company by hundreds of millions of dollars. So they check every number, every assumption, every discount rate, and when a managing director or vice president looks at that model, they do not just see numbers. They see the basis for deciding whether a deal should happen or not. What is interesting is that people entering the industry often think they are working for money. And it is true that income in finance is quite high compared to the average. An analyst at large investment banks like Goldman Sachs or Morgan Stanley may start with total compensation of about $150,000 to $200,000 per year, including bonus, but in return, they have to accept something that very few people outside the industry truly understand. The average working time of an analyst in investment banking is often around 80 to 100 hours per week. That means many of them leave the office at 2 or 3 in the morning, only to return again the next morning. Dinner is often fast food ordered quickly while editing a pitch book slide. Personal plans slowly disappear from the calendar. Someone once said that when you work in investment banking in your 20s, you are trading a part of your youth to learn how money really works. Because behind those dry spreadsheets is an extremely complex system. A valuation model is not just a financial calculation. It is the way the market looks at the future of a business. A small change in growth assumptions or cost of capital can shift the value of an entire company by hundreds of millions of dollars. But that is only the surface of the story. What analysts begin to realize after a few years is not just how to build models. They start to understand who actually decides that deals happen. Models are only tools. Presentation slides are only vehicles. They help explain a deal, but they are rarely the real reason a deal goes through. What decides a deal worth hundreds of millions or billions of dollars usually lies in 3 things that are very hard to see on an Excel sheet: relationships, power, and timing. A CEO can choose which bank will advise the sale of his company. A private equity fund can decide whether to invest or not. A bank can structure the debt in a way that makes the deal possible. These decisions do not appear in the financial model. They appear in private conversations, in relationships built over many years. And when a young analyst begins to understand that, they also begin to realize another truth. The people sitting in front of Bloomberg screens are not only working to make money, they are standing at the lowest level of a global financial power structure, a system where, at higher levels, decisions can move billions of dollars with a single phone call. What makes this story interesting is that most people entering the industry think they are stepping into a world built around money. But the longer they stay, the more they understand that money is only the surface. Underneath it is something much bigger. An architecture of capital flows, and the journey from an analyst editing Excel at 2 in the morning to someone who can influence how billions of dollars move around the world is exactly the story we are going to explore in this video. Because if you truly want to understand how the economy works, you have to understand one thing. Money does not move only with the market. It moves with the people who understand the structure of the market. Part 1: How billion-dollar deals are really created. After a few years working as an analyst, the first thing that changes is not Excel skills. What changes is the perspective on how deals are actually created. From the outside, many people think that mergers and acquisitions worth hundreds of millions or billions of dollars are decided by complex financial analysis. But when you go deeper into the system, you start to notice something surprising. Financial models rarely create the deal. They are only tools used to justify a decision that has already begun to form. When an analyst is promoted to associate or vice president, they start attending meetings with clients. At that point, their role is no longer just building models, but observing how financial power really operates. A very typical example in investment banking is debt restructuring deals. A company may be facing several $100 million of debt coming due. In theory, there are many options: issuing new bonds, taking bank loans, selling assets, or bringing in an investor. But the final decision is rarely made based only on numbers. Instead, it depends on 3 factors that newcomers to the industry usually do not notice at first. The first is the network of relationships. In the financial world, many deals begin with a phone call or a private dinner. A CEO may call a managing director they have known for years. A private equity fund may be invited into a deal because of a successful partnership in the past. These connections do not appear in the news, but they are the foundation of deal flow. The second is financial leverage. An investment bank does not only bring advice, it brings access to capital. When a bank can raise hundreds of millions of dollars from bond markets or investment funds, its advice naturally carries more weight. That is why in many large deals, the same idea presented by different institutions can have completely different levels of influence. The third is timing. In finance, timing can matter more than strategy. A company may sell itself at a high valuation during a strong market cycle, but the same company may be valued much lower just a few years later when the economic cycle changes. People with long experience in the industry do not only analyze current data, they try to read the cycle of the capital markets. This is the moment when many people in the industry begin to understand that the flow of money in the economy is not random. Large deals often move through networks of trust built over many years. A managing director may spend an entire decade building relationships with CEOs, investment funds, and other banks. When that network becomes strong enough, deals begin to come to them on their own. This explains why, in many transactions worth hundreds of millions of dollars, the name of the analyst or associate almost never appears. Their work is still very important, but they operate at the technical layer of the system. Meanwhile, the people at the top are doing something completely different. They coordinate the flow of capital and trust between large institutions. When someone in the industry reaches the level of vice president or managing director, they begin to experience this difference very clearly. At that point, they are no longer only supporting deals. They start creating deals. A managing director may call the CEO of a company and say that the current market is valuing businesses in the industry very highly, and that this could be a good time to sell the company or raise capital. A single conversation like that can sometimes open the door to a transaction worth hundreds of millions of dollars. That is the moment when many people in finance realize an important truth. In finance, real power does not lie in analyzing money. Real power lies in the ability to direct the flow of money between the people who own it And once someone understands how deals are created, they also begin to see the next level of the system, because at an even higher level, there are people who no longer only advise on deals, they directly own and control businesses. That is the world of private equity and hedge funds, where financial power begins to change completely. Part 2, where real power begins: private equity and hedge funds. After some time working in investment banking, many people in the industry begin to see a very clear limit. Even though they may work on deals worth hundreds of millions or billions of dollars, their role is still only advisory. They help structure the transaction, help raise capital, help a company find a buyer or an investor. But once the deal is finished, they leave. What happens to the company afterward is no longer in their hands. That is why many bankers, after understanding how the system works, begin moving to a different world inside finance, private equity. If investment banking is where deals are designed, private equity is where deals are owned. This difference is extremely important. An investment bank makes money from advisory fees, but a private equity fund makes money by taking control of companies. The way they operate is relatively clear. A private equity fund raises capital from large investors, such as pension funds, sovereign wealth funds, or ultra-wealthy families. This capital often reaches tens of billions of dollars. The fund then uses that money to acquire companies, usually through a strategy well known in finance, the leveraged buyout, often called an LBO. In this type of deal, the fund does not need to pay the full price in cash. It only puts in a portion as equity, while the rest is financed with debt. This allows the fund to control a large company with a relatively small amount of its own capital. If the company grows well over the next few years, the value of the investment can multiply many times. This is the model that created some of the largest financial institutions in the world. Firms like Blackstone, Allocator, and Apollo now manage hundreds of billions, even trillions of dollars in assets globally. These funds do not invest in just a few companies. They may own hundreds of businesses across many sectors, from real estate and technology to healthcare and infrastructure. But what makes private equity truly different is not just the size of the capital. The more important factor is control. When a private equity fund acquires a company, it usually becomes the controlling shareholder. That means the fund can decide the company's strategy, replace management, restructure operations, or sell the business when its value increases. In many cases, a company that was operating normally can become far more efficient simply because its financial structure and governance are redesigned. However, decisions in private equity are rarely simple. When a fund buys a company, it also takes responsibility for difficult choices. Restructuring often means cutting costs, changing leadership, or shutting down parts of the business that are not performing well. In finance, these actions are described with neutral terms like operational optimization or strategic restructuring. But behind those words are real changes that affect companies, employees, and sometimes entire industries. At this level, many people in the industry start to understand something important. Finance is not just numbers on a spreadsheet. It is a tool that can reshape companies and markets. Yet, private equity is still not the highest layer of power in the financial system. At another level, there are organizations that operate in a completely different way. They do not need to buy companies. They do not need to sit on corporate boards. What they do instead is bet on the large movements of the global economy. This is the world of hedge funds. If private equity focuses on improving the value of individual businesses, hedge funds focus on predicting major shifts in markets' currencies, interest rates, government bonds, commodities, or entire economic cycles. A correct decision about central bank policy, energy prices, or global liquidity can generate hundreds of millions of dollars in profit in a very short time. At this level, financial decisions are no longer about one company. They are about the system itself. Top hedge fund managers do not only analyze balance sheets, they watch central banks, capital flows, inflation, growth cycles, and structural changes across global markets. In other words, they are not simply investing in businesses. They are positioning capital based on the direction of the entire world economy. And when someone reaches this level of finance, another realization begins to appear. The people at the top of the system do not only make money from markets, in many cases, their decisions can influence how markets move. That is where the story enters an even deeper layer of global finance, a layer where capital is not only traded, but directed on a global scale. Final part, what most people misunderstand about money. When you look back at the entire journey from a young analyst staring at Excel at 2 in the morning to the people who can move billions of dollars across global markets, one thing becomes very clear. The financial world does not work the way most people imagine. Many people think finance is simply about making money. But once you go deep enough into the system, you realize that money is only the surface of something much larger. Underneath it is a complex network of power, information, relationships, and the ability to read economic movements before they become obvious to the rest of the market. At the lowest level of the system, young professionals learn how to analyze companies and build financial models. At the next level, they learn how deals are really created through trust, timing, and networks built over years. As they move higher, they begin to understand how capital is deployed to control businesses, restructure industries, and create value at a much larger scale. And at some point, the question is no longer, how do I make more money? The question becomes, where is the world's capital moving next? The people at the highest levels of finance do not only react to markets, they try to understand the deeper structure behind them, economic cycles, monetary policy, global liquidity, and how large institutions allocate capital. When you understand that structure, you no longer see only numbers on a screen. You start to see the architecture of the economy moving behind those numbers. That may be the most important lesson in this entire story. Success in finance rarely comes from reacting to what is happening today. It comes from seeing the forces that are quietly shaping tomorrow. And if there is one thing the journey from analyst to global capital allocator teaches us, it is this: money is not the final goal. Money is only a tool. What really matters is understanding how the system works. Because once you understand the system, you are no longer just a participant in the market. You start to see how the market itself is built. If you want to go deeper into how money really moves inside the modern economy, from billion-dollar deals to private equity and hedge funds, to the strategies used by the people at the top of global finance press, so this video can reach more people, and subscribe to the channel so you don't miss the next analysis. In the next videos, we're going to explore an even more interesting question. Who actually controls the flow of money in the world, and how does that shape the economy we live in every day?